Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
The information in this episode is general in nature and does not take into account your personal objectives, financial situation, or needs. Nothing discussed should be considered financial, legal, or taxation advice. Before making any decisions, you should consider whether the information is appropriate for your circumstances and seek independent, professional advice from a licensed financial advisor.
And welcome back to another episode of the Defence Property Podcast. Today we have a special guest who is an accountant, runs his own accounting firm, and is also ex-military. And I guess you'd have to be living under a rock if you haven't heard about the recent budget, some of the changes to the property market, and all the changes that the Albanese government has made. So I'd like to welcome Jesse from BBS Tax to the podcast. Jesse, welcome.
Thanks, Kane.
Well, I guess before we kick off, give us a soldier's five of your background with defence, and then also just talk us through BBS and tax and typical client and what you don't do.
Yeah, so I was an infantry soldier at 8-9 area for just under 7 years.
Yeah, okay.
I got med discharged, pretty bad back, and had to go back to something I could do, laying in a bed on a laptop on the bad days.
Yep.
Already had a couple of accounting quals, jumped back in, did some more study, kind of fell into a job. From there, after a couple of years, went out on my own. I've been doing that for the last 10 years.
Yeah, sweet. So 10 years. And BBS Tax, for anyone that wants to jump on Google and look Jesse up. But I guess we'll get into it. Like the budget, it's probably one of the more fruitful budgets, should we say, of recent times. Just talk us through just high level your thoughts and just for the the soldier, sailor, airman that's listening, just guide us through who the Albanese government are and the Labor and Liberal position.
Yeah, it's probably had the most negative news articles written about it in the budgets I remember. There's been a pretty big attack on kind of the status quo with trusts and capital gains. Albanese government, obviously the Labor government, they say they are for the people and the workers all the time, but it seems to me like they're just doing a little bit of a cash grab here. The main changes we're looking at are the changes to the capital gains tax regime and discretionary trusts.
Yep.
Both of those aren't usually, your everyday tax stuff. Capital gains, obviously, when you buy and sell shares, property, crypto, businesses even, any of the CGT regime events. And then trusts are, again, something that not everyone's always going to be involved in. But the people who are have kind of planned and built their lives around the rules are in place, and they've just had that kind of ripped away and really reduced. So it's throwing up a lot of uncertainty. The worst part is there was no consultation before it happened.
Yeah.
And you can see that now they made the big announcement, said, oh, we're going to do all these great things. And then basically within an hour, all the accountants, all the industry bodies, all the professionals came out and said, but what about this? And what about this? And what about this? And what about this? So no consulting, no industry feedback, not thinking about any of the unintended consequences. And that's where we're seeing those big changes like was announced last week.
Yeah.
There's going to be more in a further tranche of legislation, and there's going to be more and more changes when they realize, like, oh God, we haven't thought this.
So it was very from the hip, wasn't it? And like if we go back to 1985 to 87, when they removed negative gearing or abolished it completely, it lasted 2 years before rent skyrocketed, and we could get into how that looks in a moment. But it's very from the hip without consultation, like you mentioned, and it's just sort of let's change it and see what happens. And Albanese, like you say, for the people, but really this is really damaging to the middle class, if anyone.
Yeah, from the hip, but also they kind of broadcast they wanted to do it in 2019, back when we had Bill Shorten.
Yeah.
He wanted to get rid of negative gearing then, and they've never really liked the fact that you can do tax minimisation plan with trusts. They wanted to get rid of that. There's a lot of other options to do things. They said, we're just trying to make it so it's, they're on the same playing field as just a family. And I can think of a couple of things that would have been more beneficial for those families doing this.
Yeah.
But it is what it is. We roll forward and do the best we can with what we have.
Yeah. So historically, we touched on the first, capital gains tax, which is probably, they're just working out how they're going to tax the capital gain event in a more favourable way. So historically, if you've bought a property, and I'll use property as we're a property podcast, but this does apply to, like Jesse mentioned, shares, crypto, ETFs, any capital gain event. You buy a property for $1 million, you hold it for 10 years, you sell it for $2 million. You've made $1 million profit over that 10-year period. Your marginal tax rate might be 37 cents. You pay, you get a 50% discount on the $1 million because you held it for greater than 12 months. So the $500,000 gets lumped on top of your income and you pay it at your marginal tax rate. That's historically. So just talk us through like what the new method is.
Yeah,
with indexation and that.
Yep. So the other part of historically, when the capital gains tax regime started, any assets that were bought before that were called pre-CGT assets.
Yep.
And they were completely out of it.
Yeah.
So when you sold those, they didn't fall into it. They've been brought back in as of 1st July 2027.
Wow.
Which means that, the gain before that period of time is still ignored.
Yeah.
Anything after that will get caught.
Yeah.
The 50% CGT discount is gone from 1st of July 2027. But up to that point, any gain till that period of time, you can still use the 50% discount on.
Yep.
Then we need a new market valuation at 1st July 2027. So one big winners out of this budget is valuers. And then anything after that will be indexed with the indexation rates. The reason they brought in the 50% CGT discount in the first place was to simplify the system. Because it was so convoluted. You had to work out the quarter you bought your asset in, and then they published tables which have an inflation rate is pegged to CPI, and then you had to work out what it was when you sold it, and then do a calculation based on those two. So for accountants, it's fairly easy. You look up tables, you plug it into your software, and it works. Everyone else kind of trying to do it off the top of their head or work it out could have been a bit painful. So 50% CGT discount was to reduce that compliance burden.
Yeah.
Because less red tape, the better. And now we've just gone back to a double version.
Yeah.
So discount and then indexation. So made it a bit more complicated. I have seen some quotes from the government saying, "Oh, accountants are going to be winners out of this." No, because we just have to deal with people yelling at us because it costs twice as much now.
Yeah.
So the main thing is there's now anything that you had up till 1st of July 2027 still gets 50% discount.
Yep.
Anything after that goes to indexation.
Yep.
So, possible that purchases in the future will just be indexed. That's fine. But we're going to have that mix of discount indexation, which it'll be a little bit of a pain to do, kind of like that quick calculation in your head when you're thinking, should I do this?
And going forward, say we buy a property in August 2027, so after, so there's no 50% discount in the calculation. Is put in this example I use like $1 million purchase, sold 10 years later for $2 million.
Mm-hmm.
They just talk us through the new calculation and the indexation method.
All right. So I don't have the rates off the top of my head, but there's basically just a rate of what indexation was, and it just kind of keeps increasing as you go. And use
the cost base increases. Like if it's let's call it 2.5% inflation. The cost base increase is 2.5% every year. Yeah.
So essentially the calculation works out, if I bought this for $1 million this year, but in 10 years time, what would that $1 million have cost me now?
Yeah.
And so depending on the rate, it could be like, oh, well, that 1 million would really be 1.2 now. So it pushes your cost base of 1.2 to put into kind of the correct amount as of the day you were selling it.
Yeah.
So, well, the other part is it can go backwards too. If we have, negative inflation, which would be great. But that, they don't do negative rates in indexation. So it's really looking at putting it into current values to work out your gain. Yeah.
So in this example, it's gone up to 1.2 without getting the calculator out. And we've sold it for 2. We pay capital gain at our marginal tax rate on the 800 versus the old one, which was essentially at 500. Yeah. But there's also a rule. So in this, we've just said 800 because it went to 1.2. But there's a minimum of 30%.
Yep. So that one starts 1st of July 2028. I think that one's coming in.
Yeah.
So now it's where we have the capital gain. It is a minimum tax on the capital gain of 30%, which if you've got a big capital gain like that, you're probably sitting up above
30%, yeah,
rates
right.
anyway.
Yeah.
So not a huge change. Anyone below that, it is going to affect, but then they've brought out some relief where anyone on income supplement payments like pensions, the age pension, carers pension,
Yeah.
kind of stuff, it's not going to count towards them.
Yeah.
They don't have to pay that minimum 30%. They've got to pay their marginal rate. We'll see, I'm thinking, more and more carve-outs for that kind of stuff. And because it affects all CGT assets, you're looking at going, oh, well, you're working, you've got this house, you would have paid 37% anyway, so you're going to have to top up 7% anyway. But it's kind of like the self-funded retirees who sell off shares to kind of pay their cost of living, don't get a pension because they got too much. But where they've kind of got, yep, cool, well, between the husband and wife, we're selling $36,000 a gain, and split it, that's $18,000 below the tax-free threshold. We shouldn't pay any tax at all. If they're not getting income support payment, the 30%, it's going to hurt those people worse. Having said that, if they've got a couple of million in super and they're getting all that tax-free, not a lot of people are going to have a lot of sympathy on that side. But there's kind of those consequences where we've been planning for this for 20 years and now you've just thrown this curveball and it absolutely destroys all the planning and budgeting we've done.
Yeah, interesting. So I guess the key takeaway is, yes, the capital gain has changed. Yes, it's less favorable for, the property investor, the everyday mum and dad with, any investment. Potentially most likely in most cases is going to end up in more tax on the event of a capital gain. But ultimately it doesn't change you still need to invest or, to get ahead and build wealth. You don't not invest because of this, for that.
Yeah, look, I like to tell everyone that, tax shouldn't be the number one thing you're thinking about when you do this. Tax is obviously a factor in most of the decisions you make around this, but depending on what your goals and plan is, you should be looking at, if we're kind of doing this stuff, create long-term wealth, create income, what's it going to do? Obviously, the more you earn, the more tax you're going to pay. And I'd love to pay $1 million in tax a year.
100%.
Yeah, I've got to be earning 1, 2.
That's where people forget about, yes, it's not ideal to be paying tax, but you're only paying tax if you're making a profit. And that's the key part that people need to remember. So yes, the capital gains calculation is less favorable, but it's not an excuse to not do something, whatever that something is for each person. And then the negative gearing. This is probably the one that got the most amount of attention pre-election for Albanese. I think he was famously quoted as he was asked, are you going to change negative gearing? And he said, no, for the 50th time. Next question. So he was very, very straightforward in declaring that he was not going to make any changes to capital gains. So then obviously this is to negative gearing. And now that it's come out and he has made some changes, we've all seen Pauline Hanson's, I don't know if it's GoFundMe or her donation page. Last time I saw was like 3.5 million with a target of 5 million of public donations. And, if you do watch the news, you've probably seen that Pauline Hanson is leading the polls, which is a pretty chaotic world in my view. I'm not big on politics at all or anything, but, it's not a great state of affairs if Pauline Hanson's leading the polls. Whether she can hold that lead for 2 years or not is another thing. So he's basically going to change the negative gearing. So for the audience, negative is the cash flow on the property is negative, and gearing just means you've borrowed to buy that investment. And when it's negative, historically, you've been allowed on any property to claim that negative cash flow position each year and offset or claim it as a deduction against your tax that you pay to get a bit of a refund each year. Basically, what the government has done is remove that on established properties, and you can only have claim that against your personal income against a new build property. Whereas with an established property now, you would carry that loss forward until such point that it becomes positive cash flow, and then the positive cash flow each year pays back those losses. Then you would start paying the tax on the income or the positive cash flow after the losses are paid back. So Jesse, share your thoughts on a bit of a mouthful there, but break it down.
You've got a pretty spot on important distinction. It's only on residential property this has happened. Commercial property is still fine. Other asset classes still fine because you can borrow to buy shares.
Yep.
And negative gear that if the interest is more than the return you're getting. And they've sold it as we're making property more affordable for the younger generation to get their foot in the door. Yeah, have they? I mean, this month, the Courier Mail every weekend are running that auction rates are the lowest they've ever been. The property market's crashing. I don't know how true that is, but yeah, all of a sudden there's a lot of buyers that are now out of the market. So yeah, maybe it has made it more affordable. I don't know if any prices have gone backwards yet. I don't know if they ever will, but maybe it's going to slow the growth. But yeah, where we get to the negative gearing, essentially it's just, you've got a loss. We can offset that against the other income, bring your taxable income down, you pay less tax. And then you would kind of forecast that into, well, we can't afford the house right now, but if I'm getting a bunch of tax back, we can work that into our cash flow. And yes, we can afford to buy it. Then we're going to have, some capital gains in the future. It's going to be paid off. We're going to get income, great and long-term strategy. But then we had everyone just jumping in, just trying to make short-term capital gains. And get a big 50% discount on the gain when we got it to create income, which I guess then ended up in everyone's returns on property dropping and making the negative gearing even worse. The less rent you're getting on the more interest you're paying and the higher loans means it's less money you've got coming in. Usually the biggest deduction to get us to negative gearing after interest is also the depreciation. So the newer a build, the more depreciation we get. That then gives us our negative gearing for our taxable income. And it's important to remember that one's not a cash. It's not a cash expense.
No,
We've already outlaid that when we bought the property. So it's just on paper. So you can be really negatively geared without all of that going out in cash, which is even better. One of the parts that hurts with that though is anything you claim depreciation on your building. So the 2.5% over 40 years reduces your cost base when you sell it. And I've seen that.
And you pay that back. And a lot of these property spruiklers don't necessarily highlight that point, because depreciation, whenever you hear the term, you can substitute loss. You are making a loss and you're losing money. So if you have a brand new shiny building on a block of land that you buy versus a decrepit old house that's about to fall over, you've just got more opportunity to lose value because it's just new timber, new plasterboard, new electrics versus old. So you can't, when you buy a property and then you want to value add, you can value add to a dwelling, but you can't buy more land.
That's right.
But I think a couple of key on there making it more affordable that I'll find interesting. It's probably definitely slowed, like it's taken the wind out of the market and slowed some pace of growth immediately as people are sort of gone to that shock of catcher phase of what do I do here? And I'll just do nothing in case and just wait and see how it pans out. But I think if we look at, well, firstly is the supply and demand of real estate in Australia ultimately is the biggest driver, and our international migration and population growth, I think it's 250 to 400,000 every year. That's compounding year on year, but our new dwellings is probably half that. So ultimately we're building a lot less dwellings than our population is growing. So there's always going to be that demand factor outstripping the supply of new dwellings. But the other one is, if we look at this, like it's definitely going to cool investor activity in the market, and we've seen that, with a lot of markets have slowed. So we've got a pool of renters in Australia, and it's about 1/3 of properties in Australia are tenanted by renters, and that's not changed out of this, this budget and announcements and everything. But the amount of investors has changed, so people will stop investing. There's people that were going to buy and they can't now based on affordability and borrowing capacity. There's people that have just said, well, I'm not going to do it if I can't save tax, rightly or wrongly. You should never invest as a tax outcome, but if that's your choice, they're going to stop. So the pool of investors and investment properties has decreased, but rental demand's equal. So this will have a direct impact on rental prices, and rents should increase. So is it really affordable when people are struggling to save a deposit and now their rent's going to go up as a result of this? Are they going to even be able to get into the market? And it's only really the renters with the high amounts of surplus income to save while renting that can actually save to get their deposit. Many renters may struggle to just pay the rent, let alone save as well.
Yeah, look, it's tough question, isn't it? Because, you know, the government can come out with whatever policies they want, but us as a society did this.
Yeah.
You know, when they deregulated the home loan market in like the 90s, my dad bought a nice house in Port Macquarie. I think he paid like $140,000 for a 3-bedroom, 1-bathroom, double garage house in St. Maria Block. Affordable, fantastic. And then just the growth of everything. Now all of a sudden, you know, you can raise a whole family on a single wage then.
Yeah.
Easy done, no dramas. And we've all gone like, oh, we all want to get rich. You know, these properties should make us money and a property should never lose value, save as houses. And we've kind of done it to ourselves where we've gone, all right, well, let's just throw money at stuff because we're always going to get it back. And when I sell it, I should get every single dollar I ever spent on that place back, plus enough to retire on, plus enough to go on overseas holidays. So the government can do all they want. But I think a lot of us need to go look in the mirror too and go, wow, this is what we wanted. And now the chickens are coming home to roost. A lot of people won't like that take on it.
Yeah.
Because a lot of people don't like to take accountability anymore. But, you know, we started looking at it from a place to live and raise your family to this is going to make me a ton of money.
Yeah.
And we kind of forewent a lot of other investment activity. And I think Australia is one of the highest investment markets percentage-wise for residential property. And when you look at, you know, in shares and in business and in other asset classes, we're through the roof on residential property, a lot lower on the other ones.
Yeah.
Especially, you know, America, its business is a lot higher. So we've done it to ourselves a little bit.
Yeah, and it does underpin Australia's wealth. Like I think the size of the residential real estate markets, like 12 trillion, and you know the superannuation is like 3 or 4. So the residential real estate market is 4 times the size of the super of Australia's super. So interesting times ahead. I would final point is in 1985. Negative gearing was completely abolished in the last 2 years because rent skyrocketed. So subject to change. And I think the Liberals may or may not have come out and said that they have intentions of reversing some of these changes potentially if they were to get back in. But yeah, final thoughts, Jesse?
Yeah, look, the Liberals might change if they get back in. They could also just go like, oh, it's actually done all right for the income. So we'll let someone else cop the hate for what's happening and keep rolling forward with it. It's here. We got to deal with it, plan accordingly. The more energy you waste on jumping up and down and screaming is less you can spend on getting in front of it.
Yeah. And 100%.
Have your 5-minute whinge and get to it.
100%. It's not changed fundamentally. What we do is still, whether it's build wealth with super, build wealth with shares and investing in the ETF, build wealth with real estate, still business as usual. Bit of a kick in the teeth depending on where you sit in the you know the broader market and probably age as well. But ultimately, probably learn how does this mainly affect my position and your position, and what do you do to move forward and keep going, I guess. But Jesse, thanks for jumping on the podcast. If anyone wants to find you, where can they look you up?
www.bbstax.com.au. Jump on there. It's a website. It's contact forms on there if they want to talk to me.
Perfect. And if you have trouble finding it, just reach out to myself. Happy to connect you with Jesse. And if you want to look us up, it's Kane at discoverbuyersagency.com.au. Thanks for listening. Until next week. Take care.
Thanks.
Is that half hour or?